Welcome to Week 6, Planning for the Future. Today we're going to be speaking about a lot of things including investment basics, stocks, bonds, mutual funds, ETFs, real estate. We'll be speaking about superannuation, contribution strategies, investment options, government incentives, and we'll be looking at insurances, essential insurance types, insurances and superannuation. We're going to be looking at estate planning, which a lot of people tend to avoid. We're going to be looking at wills, power of attorney, beneficiary designations. Throughout this presentation, we'll provide practical information to help you build a strong financial foundation. As other weeks, we'll also include a workbook with activities to help you apply these concepts to your personal situation. Let's recap from last week. Financial fundamentals we talked about, where we started with banking basics, understanding different account types, and how interest rates and fees impact your finances. We talked about credit management. We looked at credit scores, their importance, and strategies for building and maintaining good credit. We looked at healthy debt relationships, developing responsible approaches to credit cards, loans, and buy now, pay later services. Financial self-care, incorporating financial check-ins into your routine and celebrating progress through visualization and affirmations. Let's look at types of investments this week. There are stocks. That's where you have partial ownership in a company, potential high returns, but with greater risk. Let's look at bonds. They're debt securities, where you lend to the government or corporations and you get an interest payment over a specified period. Then we have managed funds. That's pooled money from multiple investors, diversified portfolios managed by professionals. And then there's ETFs, they're exchange-traded funds, features of managed funds with trading flexibility of stocks. You also have real estate, that's income generation, potential appreciation on the real estate, it's a tangible asset, and there's capital and management appreciation. Annuities, lump sum purchase. You get set income for agreed years or life. Now, you need to understand different investment types. It allows you to create a diversified portfolio aligned with your financial goals, your risk tolerance, and your time horizon. Shares and stocks, building wealth through ownership. Ownership structure. You are a partial owner with rights to company assets and profits proportional to your shareholding. Trading mechanisms. This is where stocks are bought and sold on organised exchanges. Shareholder benefits. You may receive capital appreciation if stock prices rise. There's dividend payments from company being a portion of the company's profits. Market participation. This is stock investments connect individual investors to the broader economy. Investing in shares provides opportunities to build wealth over time through both income generation and capital growth. Stock market benefits and risks. The potential benefits, let's look at those. You have capital appreciation, regular income from dividend distributions, voting rights in company decisions, transparency through financial reporting, liquidity and ease of trading. Look at the associated risks. Market volatility causing price fluctuations, business-specific challenges, economic downturns, political and regulatory inflation eroding purchasing power, tax considerations or implications. Remember that historical performance doesn't guarantee future results, and investment decisions should align with your financial goals, your time horizon, and your risk tolerance. Understanding bonds, lending for returns. You have fixed income investment. A bond represents a loan from an investor to a borrower, so the government or corporation. The key characteristics are it's on face value, there's an interest rate, a maturity date, you have yield, there's credit quality. Practical example. When investing $10,000 in a 10-year government bond with 4% annual interest, you receive $200 semi-annually for a decade, plus the full principal at maturity. Let's look at safety profile. It typically offers lower risk than stocks. The portfolio stable, predictable income, and there's capital preservation. Managed funds, pooled investment power. Pooled investment structure combines capital from multiple investors. Professional management, it's managed by financial experts. Diversification advantage, It spreads the risk across multiple securities. Fund specialisation. Various types for different investor needs. Managed funds offer several advantages for investors, particularly those with limited capital or investment expertise. By pooling resources, funds provide access to diversified portfolios that would be difficult to build individually. Exchange traded funds, ETFs, where flexibility meets diversification. Hybrid structure. ETFs combine mutual fund diversification with stock-like trading flexibility, index trading. Most ETFs are designed to closely mirror specific indexes like the S&P 500 or the Australian 200. Instant diversification, exposure to dozens or hundreds of underlying securities. Cost efficiency, lower expense ratios than actively managed funds due to their passive management approach. Trading flexibility, well, ETFs can be bought and sold throughout trading hours at real-time prices, offering greater control. Let's look at real estate as an investment vehicle. What are the advantages of real estate? Long-term appreciation potential, regular rental income, creating passive cash flow. It's a physical asset ownership, providing security. Tax benefits through deductions, protection against inflation. What are the challenges of real estate? Substantial initial capital requirements, costs a lot of money. Limited liquidity compared to financial assets. There's vulnerability, ongoing responsibilities, interest rate fluctuations, vacancy risks, tax considerations and implications. Ownership structure considerations. Incorporating real estate in your investment strategy. Let's look at portfolio diversification. It moves independently of stocks and bonds, potentially reducing overall portfolio volatility. Let's look at the investment objectives. Well, the goal is to receive income, rental yields, capital appreciation, which is property value growth, or ideally a combination of both. Market knowledge. You need to understand local markets, property valuation, tenant demographics, regulatory environments. For example, you might buy a property in a mining town. The mining company might go out of business. That was the only thing supporting that town. All of a sudden, your property goes from worth something to zero. Alternative options. Direct property ownership isn't the only way to invest in real estate. Understanding investment risk and return. Let's look at risk. The possibility of losing invested capital. Let's look at the return. Profit or loss as percentage of initial investment. Risk-return relationship. Higher potential returns typically require accepting higher risk. What's the personal risk tolerance? Individual comfort level with investment volatility. We're all different. Typical investing timeframes. A short period is from now for 2 years. A medium period is 3 to 5 years. Long term is 5 years and over. Essential financial metrics for investors. These metrics are like tools or scorecards that let you evaluate and then decide if a company is worth investing in, whether it's under or overvalued, and how risky it might be. There's metrics like dollar cost averaging, net asset value, earnings per share, return on investment, return on equity, price to earnings ratio. Superannuation, your foundation for retirement. This is compulsory retirement savings. Superannuation forms the cornerstone of Australia's retirement system. There's tax advantage growth. Super contributions and investment earnings benefit from concessional tax treatment. It is financial security. A well-managed superannuation account provides financial independence in retirement, and retirement's coming, so best we get on with it. The decisions you make today about your contributions, investment options, and fund selection will significantly impact your quality of life in retirement. Understanding superannuation contributions. We have employer contributions, and this is where it's compulsory for employers to contribute to your superannuation. Currently, it's been 11.5, but it's just moving into 12% in Australia. Voluntary contributions, salary sacrifice, personal deductible contributions, after-tax contributions. There is government support. There's co-contributions for low to middle income earners. And there's also spouse contributions for partners with lower incomes. Contribution limits. Concessional and non-concessional cap supply, Catch-up contributions, there's rules and eligibility and limits apply. Let's look at investment strategies within your superannuation. Need to understand options. Explore available investment choices from growth to conservative. Assess risk tolerance. Match strategy to personal comfort level. Timeframes with volatility. Let's monitor performance. Regularly review and adjust as needed. How about diversify holdings? Can spread investments across different asset classes. Accessing your superannuation. Preservation age requirements. You can access your super upon reaching preservation age, which is between 55 and 60, depending on your birth year and meeting a condition of release, typically retirement from the workforce. Withdrawal options. Choose between lump sum withdrawals for immediate access to capital or income streams through account-based pensions or annuities for regular payments. Tax considerations. Tax treatment varies based on your age, withdrawal method, and whether funds come from taxed or untaxed sources, with most withdrawals tax-free after the age of 60. Special circumstances. Early access may be available in specific situations, including severe financial hardship, terminal medical conditions, permanent disability, or certain compassionate grounds. Strategies for maximising your superannuation. Additional contributions. Making regular voluntary contributions, even small amounts, can substantially increase your retirement savings over time. Salary sacrifice arrangements. It reduces your taxable income while boosting retirement savings, potentially creating dual tax benefits. Government contributions. Co-contributions. Low to middle income earners can receive up to $500 in government co-contributions. Spouse contributions. Contributing to your partner's super can help balance retirement savings between couples. Government incentives for superannuation. $30,000 concessionally capped. It's the maximum annual before tax contributions as of 2026. $120,000 non-concessional cap. It's the maximum annual after-tax contributions. $500 co-contribution maximum. So the government match for eligible low to middle income earners. And there's $300,000, which is the downsizer contribution. It's the maximum eligible contribution from home sale proceeds. And all of those amounts that I've just quoted are as at the time of recording, 2025 to 2026. Navigating life changes and your superannuation. Let's look at career breaks. During periods like maternity leave or career transitions, consider maintaining voluntary contributions if possible. Relationship changes. Superannuation is considered a relationship asset during divorce proceedings. Health challenges. In cases of severe medical conditions or financial hardship, early access to superannuation may be possible. Life rarely follows a smooth, predictable path, and your superannuation strategy needs to adapt to changing circumstances. Superannuation review. Policy evaluation. Review current super accounts and fee structures. Insurance assessment. Identify embedded insurance coverage and adequacy. Contribution analysis. Examine additional contributions beyond employer superannuation guarantee. Incentive eligibility. Qualification for government programs. You may be qualified. Risks of consolidating super. Consider your insurances. Insurance, protecting what matters most. Insurance plays a crucial role in comprehensive financial planning by protecting against unexpected events that could derail your financial security. Various insurance types serve different protective functions, from replacing income during disability to providing financial support for dependents upon death. Let's look at life insurance, financial protection for loved ones. There's term life insurance. This provides death benefit coverage for a specified period, typically 10 to 30 years. Premiums remain level. Beneficiaries receive the policy's face value as a lump sum. Let's look at whole life insurance. Permanent coverage lasting for the insured's entire lifetime with guaranteed death benefit. There's higher premiums than term insurance. There's universal life insurance. Now, this is adjustable. The premiums are adjustable and death benefits are applicable. Cash value component grows based on current interest rates. It offers greater flexibility than whole life, but with less certainty. The right life insurance type depends on your specific needs, your budget, and long-term financial goals. Income protection, safeguarding your earning power. Coverage purpose, replaces portion of income during inability to work. Benefit period, well, short term is 1 to 2 years, or long term is usually to retirement. The benefit amount, usually 75 to 85% of pre-disability income. The waiting period, well, that's the time before benefits begin. 30 to 90 days is typical. When selecting income protection insurance, carefully consider key policy features, including benefit amount, waiting period, and benefit duration. These factors significantly impact both premium costs and the level of protection provided. Specialised insurance, TPD, and trauma. TPD is total and permanent disability. Provides a lump sum payment if you become permanently disabled and cannot work again. This payment helps cover living expenses, medical costs, home modifications, you might need rails, this sort of thing, and long-term care needs. Then we have trauma insurance, also called critical illness insurance. Trauma coverage pays a lump sum upon diagnosis of specific serious conditions like cancer, heart attack, or stroke. Key insurance considerations. Needs assessment. Evaluate your financial obligations, dependents, and future requirements to determine appropriate coverage levels. Policy evaluation. Carefully review terms, conditions, exclusions, and definitions before purchasing. It can be a minefield if you don't. Cost-benefit analysis. Balance premium costs against protection benefits, finding coverage that provides adequate security without unnecessarily straining your budget. Regular review. Reassess your insurance portfolio as life circumstances change, and they will change. These conversations, though sometimes uncomfortable, help ensure shared understanding of financial protection strategies and prevent surprises during difficult times. Insurance through superannuation. Available coverage types. Most super funds offer life insurance and TPD coverage as default benefits, with some also providing income protection. Coverage evaluation. Default insurance through super often provides basic protection that may be insufficient for your specific needs. Cost considerations. Insurance premiums are deducted directly from your super balance, preserving current cash flow, but potentially reducing long-term retirement savings. Comparative analysis. Compare your super fund insurance with standalone policies in terms of coverage, cost, definitions, and claim processes. Insurance outside superannuation. Professional financial advice. They'll assess your specific protection needs. They'll recommend appropriate coverage types and levels and help navigate complex insurance products and features. Then there's general advice options. They'll provide general insurance advice, products designed for specific situations. Simplified access, no personal advice or medicals though. Then there's customised coverage. Standalone insurance policies typically offer more tailored protection with greater flexibility in coverage. Application process. Individual policies usually require more detailed health and lifestyle information, potentially including medical examinations. Insurance planning workbook. Let's have a look at health event contingency. Consider potential scenarios where unexpected health events might impact your financial situation. Visualise specific challenges that could arise and how they would affect your income, expenses, and overall financial stability. Next is resource inventory. List all available resources you could draw upon in emergencies, including insurance coverage, emergency savings, potential family support, borrowing capacity, and assets that could be liquidated if necessary. Financial timeline. Review how long your financial resources would sustain you if unable to work. Calculate essential expenses and determine whether your emergency fund, insurance benefits, and other resources provide adequate coverage for 3, 6, 12 months or longer. Family discussion. Identify key people with whom you need to discuss emergency financial plans. Ensure partners, dependents, and potential caregivers understand your insurance coverage, where to find important documents, and what steps to take during a crisis. Completing this workbook helps identify potential gaps in your financial protection strategy. The goal is not only to assess insurance needs, but also to develop a comprehensive emergency response plan that addresses both immediate and long-term financial challenges. Estate planning, securing your legacy. This is so important. Estate planning encompasses more than just distributing assets after death. It provides comprehensive instructions for managing your affairs during incapacity, and it ensures your wishes are honoured, both during life and after passing. Let's look at wills, the foundation of estate planning. Asset distribution. It's how you want your assets distributed after death. It leaves clear instructions. Executor appointment. Trusted individual responsible for administering your estate. Think carefully. Paying debts. Filing tax returns. Distributing assets according to your instructions. These are all things that person will be doing for you. Guardian nomination. Name guardians to care for the children if both parents die before children reach adulthood. Legal protection. This reduces potential disputes among family. Power of attorney. Managing affairs during incapacity. They act in your best interests. The primary obligation of all attorneys is to exercise reasonable care, make prudent, informed decisions, maintain accurate records, document all financial transactions. To avoid conflicts of interest, they keep principals' interests paramount. And to protect privacy, they maintain confidentiality of affairs. Let's look at the types of powers of attorney. There's a general power of attorney, grants broad authority in legal and financial matters for a specified period. What's an enduring power of attorney? Continues even if the principal loses decision-making capacity. Covers both financial and legal matters. Medical power of attorney authorises someone to make healthcare decisions when the principal cannot communicate their wishes. Financial power of attorney focuses specifically on financial affairs. Limited power of attorney restricts authority to specific transactions or a time period. Somebody might be travelling overseas and just wants to make sure that their affairs are in order for a set time only. Beneficiaries, receiving your legacy. Family inheritance. The most common beneficiary relationship involves passing assets to immediate family members, including spouses, children and grandchildren. Charitable bequests. Many estate plans include provisions for charitable organisations. My mum left money to a cattery. Special arrangements. Some beneficiaries require specialised inheritance structures. Understanding beneficiary designations. Legal purpose. Beneficiary designations create direct contractual arrangements between asset owners and financial institutions regarding asset transfer upon death, streamlining the inheritance process. Covered assets. Designations apply to specific financial products, including life insurance policies, retirement accounts, superannuation, certain bank accounts, and investment accounts with transfer on death provisions. Legal precedent. These designations typically override conflicting instructions in your will for the same assets, making them powerful estate planning tools that operate outside the probate process. Multiple beneficiaries. You can name multiple beneficiaries with specific percentage allocations, as well as contingent beneficiaries who inherit if primary beneficiaries predecease you, providing flexibility and backup options. Let's look at superannuation beneficiary arrangements. Non-binding nomination provides guidance to the super trustee regarding your preferences, but the trustee retains discretion in distributing your death benefit. Binding nomination legally instructs the trustee on how to distribute your death benefit. These can be lapsing, requiring renewal every 3 years, or non-lapsing, remaining valid until changed. Reversionary nomination, available for income streams in retirement. This option allows pension payments to continue to your nominated beneficiary after death. Eligible beneficiaries. Super benefits can only be paid directly to dependents, spouse, children, financial dependents, or your legal personal representative, the estate. Consequences of not nominating beneficiaries. Well, then it's at the trustee's discretion as to what happens with your money, etc. There's usually an investigation process to make sure everything's above board. It extends the time frame as to when everything gets distributed, and it's uncertain with the outcome. The absence of beneficiary nominations can create significant uncertainty and stress for families during bereavement. Estate planning workbook, will documentation. Review whether you have a current will and confirm its location. Ensure your executor knows where to find your will and can access it when needed. Document review schedule. Establish when you last reviewed your will and powers of attorney. Estate planning documents should be updated after major life events, marriage, divorce, births, deaths, and reviewed at least every 3 to 5 years to reflect changing circumstances. Beneficiary inventory. Create a comprehensive list of all beneficiaries named in your will, superannuation accounts, life insurance policies, and other assets with beneficiary designations. Document organisation. Compile a master file containing estate planning documents, account information, property deeds, digital asset access instructions, and contact information for professional advisors. Share its location with trusted family members. No doubt you have some questions and thoughts having gone through this week's information. There is a code where we'd love to hear from you. You'll see the QR code displayed. And just like you, we very much wish to be always improving so that we may help more people live financially healthier lives, centred around wellbeing. And that's why we would really appreciate your thoughts and feedback on this program. We would be grateful if you'd just please spend a couple of minutes to complete this survey. Thank you for participating in this course. And remember, it all starts with you.